All right. Good afternoon, everybody, and welcome to today's webinar on delivering a simplified insurance experience. My name is Tim Kehrer. I'm with Kehrer Bielan Research and Consulting. We're going to give folks a few more minutes to sign in. I can see that the virtual room is filling up, so I'm going to give a couple of minutes for that to happen. While we're waiting for that, I'm going to go over how you all in the audience can join today's conversation. We're set up to do that in a couple of ways. You can click the raise your hand button on your screen. That'll actually allow you to join today's virtual panel. You can join us via audio or video as well if you're set up to do that. Again, you can get to that feature by clicking on raise your hand. I'll get a notification and I'll be able to allow you to join us. You can also send us your questions and comments through the chat function. That's also a button on your screen. All of us on today's panel will be able to see those chats as they come in, and we'll do our best to get to your questions and bring your comments in as they fit. I can see that a few folks are still signing in, but in the interest of time, I'm going to go ahead and kick things off. Once again, my name is Tim Kehrer. I'm with Kehrer Bielan Research and Consulting. We're pleased to be hosting today's webinar on delivering a simplified insurance experience. We wouldn't be able to do any of this without the support of our sponsors. I'd like to thank them now. Our sponsors for today's event are Cover and Haven Life. Thanks to you both. We were chatting in the green room, prior to starting today's broadcast, and we think that we've done around 25 webinars at this point, and I know that I start a lot of our virtual dialogues off with this point, but just like a lot of the world, right? We were forced to transition something we used to do in person into a virtual setting. And that's what today's virtual dialogue is, right? We would prefer to be doing this face to face, but circumstances don't quite allow for that yet. Like all of you, we've had a lot of experience doing these virtual things at this point. And one thing that we found works particularly well when it comes to recreating the sort of dialogue that we would enjoy at our in-person study groups is to bring a handful of people onto your screen, allow them and us to sort of lead the discussion, but again to really rely on you all in the audience to get involved as well. We find it's a richer experience for everyone when we hear from you, in addition to hearing to the folks that are going to be on your screen. I am going to stop sharing my screen for just a moment while I introduce today's panel. It's nice to be able to actually see everybody all at once. Joining us today, we've got Terry Evevold from Cetera Financial Services, Mike Kalin from Cover, Clark Smith from Truist Life, and Wade Seward from Haven Life. We've also got, along with myself, a couple of other members of the Kehrer Bielan team. One of our principals, Ken Kehrer. We hope that our other principal, Peter Bielan, will be joining us shortly. And joining me today is the sort of the fellow or co-ring leader of today's circus. We've got Steve Lipker. Once again, as I mentioned before, we'd really like to hear from all of you that have joined us in the virtual audience as well. Click on the raise your hand button if you want to join us on the screen, or send us your questions and comments through the chat function. As I often do, I'm going to kick off today's event by sharing a little data. If you've tuned into these things before, you've seen me present slides like this one. and you know I'm going to say that this data is data that we collect in an attempt to gather the most complete view we possibly can of the delivery of investment services through banks and credit unions. So the data here come from a combination of the third-party broker-dealers that support financial services and their partner financial institutions, as well as the bank-owned broker-dealers. And together, those two sources of data account for 95% of all the banks and credit unions that are in this business. So, again, a very complete view of our industry. What I'd like to highlight for you out of this chart today, are a few things, but let's start with the solid lines at the bottom of the screen. Those lines represent the share of total investment services revenue derived from insurance sales. Without differentiating between the two lines for a moment, you can kind of step back and take a wide angle view of this. And one thing's pretty clear, right? As a share of the business, insurance sales haven't grown over the past several years. The data that we're looking at here goes back to 2013. And over that time period, the share of investment services revenue in banks and credit unions that comes from the sale of in insurance products has hovered somewhere below 5%. We haven't really seen a dramatic shift. Most recently, you can see that among the large banks that own their broker-dealer, that's the blue solid line, the share of revenue derived from insurance sales declined somewhat from 4% in 2019 to 3% in 2020. Among the banks and credit unions that work with the third-party broker-dealers, life insurance sales look like they went up a little bit over that same time period, 1% of total revenue in 2019, 2% of total revenue in 2020. So perhaps a step in the right direction, but nonetheless, 2% of revenue is exactly where we stood as a group, or those banks and credit unions stood as a group several years ago. And among the larger banks, kind of a similar story, right? There was perhaps a small increase in sales in the sort of the 2013 to 2016 timeframe. Since then, those have slid back down, and among those large banks, today stands at 3% relative to the 4% that it was way back in 2013. Notice that the large banks that own their broker-dealer have consistently enjoyed a higher share of their revenue being derived from these sales. This has been something that's been the case throughout this time period. We could actually extend this chart further back, and that would still be true. It's another point along those same lines that's worth making is that the bank broker-dealers, the bank-owned broker-dealers, account for the biggest chunk of the industry. So around 2/3 of all the financial services revenue produced by banks and credit unions comes from the bank-owned broker-dealers, comes from those larger banks. So combined with the fact that insurance sales represent a larger share of total revenue in the big banks, and that the big banks are producing the bulk of the revenue, when it comes to where life insurance sales are happening in financial institutions today, it's really concentrated in those larger banks. We used to speculate, several years ago about why that was, and one point that was often brought up, right, is that the larger banks enjoyed the having larger scale. It was easier for them to make the investments in the training, and apropos of today's conversation, the tech needed to drive better life insurance sales. That argument, I think, feels like it holds less water today. You know, a lot has changed over the past several years, particularly on the technology front, and we will talk about that some today. And it could be that as those technologies have improved and as they've become more widely available, we're seeing the playing field kind of level out between the smaller institutions and the larger ones. That could be why we've seen this differential kind of get squeezed down in these more recent years, right? So again, as it stands today, the large banks only do marginally more insurance business as it relates to the overall business compared to smaller institutions. It's also, you know, I think worth thinking about that even though this chart makes it look like life insurance sales in financial institutions have been flat, that's not entirely the case. As a share of the business, it's remained flat. But over these several years, there's been top line revenue growth, right? So even though insurance isn't growing as a share of the pie has grown over these past several years. So advisors in banks and credit unions are selling more insurance today than they were several years ago. But those sales aren't driving the top line growth. What is driving that growth by and large is fees on advisory accounts. And those are the dotted lines on this chart. So, you know, this is a story that I think we're all intimately, you know, is very well known to us. We've all lived through this transformation. But I put advisory revenue on here for a couple of reasons, right? One, I think, is to demonstrate the possibility. Going back several years, or again, if we were to extend this chart even further back, right, we would see that fees on advisory accounts accounted for an even smaller share of revenue. But when the firm comes together around a strategy and a priority, and they receive this, the firm receives the support that it needs to execute on that, as happened within the transition to fee-based business, it's possible to transform the business, to really radically transform the business over a relatively short time. And we've seen that over this time frame in the transition from transactional business to fee-based. The other reason maybe why I included advisory here is that I think that this chart speaks to where our collective focus has been. And to the extent that our focus has been on growing fee-based business, our focus may not have been on growing life insurance. And the data certainly would seem to reflect that. I'm going to share some more data with you now that I think is going to reinforce both of those points. This comes from a slightly different database. As I mentioned before, the data on the previous slide covers as many of the 3,000 banks and credit unions that offer these services as we can possibly get data on. In addition, we collect more detailed data from a smaller subset of those firms. Around 300 of them provide data to us every year. That data feeds into our benchmarking studies. It also feeds into our dashboards, which the 2020-2021 dashboards are going to be published next week. So I'm giving you a little bit of a preview here. Now, these 300 or so firms, right? So 300 of the out of the 3,000 total, they tend to outperform the industry as a whole. That is to say, their advisors have higher average productivity. Their advisors manage larger books of business on average, and certainly they produce a much larger share of revenue from fees on um, uh, from fee-based business. Excuse me. Um, but that is not the case when it comes to life insurance sales. I've got the top line in this table here represent the bank-owned BDs. I have this on here primarily for reference. This is actually the same data that you would have seen on the previous chart. But the regional and community banks and the credit unions below, so these are institutions that work with the third-party broker-dealers, you can see life insurance as a share of total revenue is much smaller among this group of relatively elite firms than we see across the broader industry. So the mean share of revenue produced from insurance sales in regional and community banks is 0.9%. That's about half of what we saw on the previous slide, right? 2% versus 1%. It's even smaller among the credit unions that we study. It's all the way down there at around 0.5%. Excuse me. One of the gifts of the kids being back in daycare is they've started bringing colds home again. Sorry about that. So even though these are relatively elite programs among the ones that we study, that doesn't necessarily follow through to life insurance. It actually seems like the more elite the firm, the more likely they are to have neglected growing that piece of their business. It's also worth noting here that the mean average, both among banks and credit unions, the mean average is quite a bit higher than the median average. Whenever you see that, you know that there are some outliers at the high end in your sample, and that becomes clear when we look at the top quartile average. And I've also tacked on here what the highest performer out of all the firms is in each of these categories. And you can see that life insurance production is concentrated among a few firms that are at the high end of this scale, right? So there are a few banks and a few banks that work with the third-party broker-dealers that derive more than 10% of their revenue from insurance sales. The number is much lower among credit unions. That is to say, credit unions sort of continue to derive even less of their revenue from this source. But nonetheless, there's a similar pattern in the data that production tends to be concentrated among a few credit unions at the top of the range. There's less variation among the bank broker dealers, but nonetheless, I think that this data reinforces that the notion that there are firms out there, there are financial institutions out there that are doing something different and have made insurance a core piece of what they do. And as it stands, those are the firms that are best positioned to take advantage of changes that we see happening on the client front, right? So this data comes from yet another source called the Macro Monitor Survey. That's a nationally representative sample of consumer financial behavior. It's a terrific database conducted every 2 years, covers over 4,000 US households. One of the thousands of data points that they track through the survey is they ask the household that's filling it out, how much do you agree with the statement I don't have as much life insurance protection as I should. Um, there was a notable shift in this measure in the most recent round of data, which was collected during the summer of 2020, so kind of deep into the COVID crisis. Um, as you can see, for the several years prior to that, uh, concerns around having adequate life insurance had been declining. Fewer and fewer households were likely to uh, uh, um, uh, uh, agree with this statement. Excuse me. Um, however, between 2018 and 2020, there was a noticeable rise in concerns around having adequate life insurance protection that undoubtedly was the result of the COVID crisis. And we could spend a lot of time talking about that. But as it pertains to today's conversation, this suggests that we are living in a time period when there is increased consumer demand for these products. And banks and credit unions, this same data, the same Macromonitor survey tells us that banks and credit unions are the most trusted provider of financial services. That's particularly true among credit unions. This should give our industry a leg up when it comes to capturing the growing market for insurance. But as the slides that I shared with you previously suggest, it certainly doesn't look like we've been getting that done. So I'm going to turn it over to Steve. Steve, what are we going to do about this?
Yeah, thank you, Tim. I really appreciate that. So I wanted to kind of cite this study here. It's a McKinsey study from a couple years ago. And I kind of want to just set this up a little bit as sort of a transition, right? So Tim has really outlined the problem here. We all know the issue. We're just not getting the result we want, but at the same time, we know the opportunities there. So the goal of today, and obviously when we start our great panel discussion that we've got with our panel here, the goal is to really kind of look at this problem and solution differently, and that's why we wanted to bring technology into play and into the conversation today. So, as you can see right here from this McKinsey study, there are three things. Now, this is from a life insurer perspective, but it's very relevant, as you'll see as we kind of pivot into the discussion. So, these are the three kind of main key points that life insurers are looking at in order to really solve this problem and evolve from a technology standpoint. Number one, it's digitization, and it's modernizing the existing channels that we're trying to sell life insurance through. Secondly, it's differentiating, and we'll talk about this a lot with our panel that we have here. And I'm a very, very strong proponent of this, and that's delivering that great customer experience from start to finish. Are we doing that? Probably not, but I think we can. So that's a really important point as well. And then thirdly, and you've all heard this word disruption, right? Kind of turning the industry upside down. And how are we doing that? And there's a lot of different ways to do that. But McKinsey cited the use of data, all this data that we have available to us in our financial institutions. How can we use that data to our advantage from a technology standpoint to really get the result we have? So we'll talk more about all of these points later on, but I wanted to, again, use this to sort of really set up the panel discussion that we've got looking forward here. And we will go ahead and jump in. Thank you again, Tim. And again, thank you to the panel that we have assembled here. And I'm going to go ahead and kick things off. I'm going to start off with Mike here. Mike, in your role with Cover, obviously you've seen some key innovative technology advances, let's just say over the past 5 years. In your view, what are some of those advances that you've seen that you think can drive more insurance and sales activity through financial institutions?
Yeah, no, sure, Tim. I mean, I'll highlight three just to kick off the discussion. So I think top of my list is the insurance carriers have gotten better. The insurance carriers have delivered simplification and the ability to deliver fully underwritten policies, meaning rated policies on an instant or rapid basis, up to $3 million of coverage. Like, we could not have said that 5 years ago. The state of the art then for instant decision was simplified issue, which was non-rated. So that meant healthy people got poorer rates, and those products were never best for customers. So, I mean, I can state, 12 insurance carriers that have done phenomenal things to get high quality insurance instantaneously to the client, meaning in 22 minutes, a client can do a needs analysis, fill out the application, get a decision, give their credit card, and get their $3 million policy in 22 minutes. Preferred best, like, that's huge. And you have Haven Life on the call today. They're one of the 12 that I think are just doing great things. So I think, first of all, the insurance carriers and everything that sits behind them in terms of automated underwriting and the use of data has definitely gotten better. So that's number one. Number two, the ability to integrate insurance solutions with the desktop of advisors, or embed solutions in a website or a mobile app. Like, that's really important, because it's no longer set aside from everything that a bank customer will do with either their advisor, or if they're interfacing with their electronic banking statement or their mobile app or their loan. Everything through APIs and single sign-on and mobile app development, we can deliver the insurance experience right in that same journey. And it's everything from integrating it with financial planning for advisors all the way through direct to consumer purchase journeys. And then I would say the third thing that we can do now is through AI and comparative quoting, we could, in a flash, compare for customers which product is best for them. Should they go with term versus perm? Do they need long-term care or disability income? And should they go with Prudential or John Hancock or Haven Life? We can make those choices for them, real time, with them being engaged in the process. So, insurance carriers are better. Things are really integrated now, and we can give consumer choices real time. And I think those three things are super exciting for what's coming, or what's here, and kind of what's going to continue to come next.
Terrific. I'll open it up to the panel as well. Clark, Terry, or Wade, any additional thoughts on what Mike had mentioned?
Yeah, I guess I would say that, so I've been a life insurance guy for 28 years, and for 28 years, we've been talking about simplifying the process, but everything was incremental up until, 4 years ago or so. And now it's really transformational, right? And it's because the technology finally got to a place where we could deploy it the way that Mike was talking about. So it's just, it's night and day between where we are today versus where we were just a few years ago.
Well, I'll jump in on that. We can't let the issue that we have today not be recognized with the pandemic, because we've seen more innovation in the last 19 months in the insurance industry than we've seen in the last 19 centuries. There's been more adoption to utilizing the tools finally versus outsourcing the systems to somebody else. And I really think that the partnerships that people form and formulate, and I've been a partner of Mike's for 2016. I launched a platform at a large regional bank, and 91 days later, I came back to Cetera and did the exact same thing here. And I can honestly tell you that I'm so blessed that we went from launching in 2016 with Cover, because when COVID hit, we were already there. We were electronic, we were digital, we were e-sign, we were e-deliver, and we had the experience, and we didn't let the pandemic get in our way. And that to me was pretty critical. And for those of you that haven't had that opportunity yet to grow into that digital experience, it's ever changing, and it's never too late to jump in.
Yeah, I think one key, with what Mike said, really goes back to the first chart that Tim went over. Like all of us on this call, we may be competitors, but we really don't compete. Like my 3% of revenue is not competing with your 3% of revenue, and I'm not at 4 because you're at 4 or something like that. We're competing ultimately with advisory business is my true belief. So from an advisor, from a banker, there is so much top down for recurring revenue. And believe me, there's top down for other revenue too. But what advisory business has done is they've digitized everything. It is so easy to open up, an advisory account. And I'd say for the first time, going over things that Terry said and Michael said and Wade, is we're now starting to finally compete with the ease of the fastest growing business. I mean, if we were as simple as advisory, we would have almost the same growth rate, other than we get to decide whether, a carrier gets to decide whether you deserve insurance or not based on your health and other factors. But to me, that's everything. As I compete internally, with my revenue line versus others at Truist Bank, it ultimately comes to the advisor and bankers. What's easier for them to implement in their business? And then when it gets to the client, going back to, like Mike said, 22 minutes, the client's probably going to say yes. 22 days of sitting in the mail and going through things, the client's going to forget what they even agreed to, and we don't get it sent back. So I think ultimately, that chart that you were showing, we're competing against that top line, in trying to grow our business.
Right. Great points, guys. Mike, I wanted to go back to you for another point here. It'd be great, right, if we could just sort of plug in some newfangled technology, right, and it magically poof right away, to increase sales activity. We know that's not the case, but kind of in your view, Mike, as it regards to the process, tell me the 3 keys that financial institutions have to understand and address in order to use technology to your advantage. I know one of the points you're going to make, and I really like this because Tim mentioned it earlier, is that the financial institutions, right, they're a trusted source, and people want to buy insurance from them. And I know that's one of the points you're going to make, but what are the other 2 that are really critical?
Yeah, I mean, you hit the first one. I mean, all the research and all of our results have shown that the research which says customers prefer to buy from trusted brands, everything about that we feel is true. But it had, to Clark's point, if it's not integrated, like it doesn't have the brand of the bank or the credit union, if it's not on their mobile app, if the death benefit proceeds aren't on the account statement, if you can't get to your insurance policy through the bank's 800 number and route it over, it's just outside and it's going to deflect off like something deflecting off of the atmosphere of the earth. It's going to hit and deflect off, right? It's got to be integrated. So, the way to get integrated, we've found at Cover, and we've got a decent amount of partners, whether it's the chief digital officer, the chief innovation officer, the CTO, the head of the consumer bank, the head of innovation in the wealth department, they have to be the co-champion of this initiative. Every financial institution is going through digital transformation. And if life insurance stays outside of digital transformation, it's going to continue to lose share. The period, end of stop. So if you can get in behind the firewall, fully integrated with the CRM system, with the CRU system, with the account management system, so that data is pushed to the client and pushed to the advisor. If you're integrated in the website, so the advisor is single sign-on and pre-authenticated, like if you're in there, you have a chance to scale. If you don't, we're going to be stuck at 1 to 2%. Right? I mean, there's many other things, but that's the thing. That's the tipping. I think everything else has to come. The journey has to be better. The products have to be great.
Sure.
It's got to be delivered when and how the client wants it. but that's the key to scaling.
Got it. Got it. Clark, Terry, or Wade, anything to add there? That's a terrific point, Mike. I appreciate that.
Amen. I think you said it perfectly.
And I'll say this too, because I think, life insurance is still a relationship. It's a relationship between financial institution, an advisor, a bank, credit union, and their members and clients. It's still relationship driven, and we can't take that experience away. But I will say this: if life insurance got the same amount of play as what advisory does with inside of a financial institution, a credit union, or a broker dealer, meaning that it was that important to the top of the executive team, we would see a dramatic increase in the amount of life insurance sales that we would have, because it is not easy. It's getting easier, but it is still not easy as what advisory is. So my recommendation to everybody is get behind the wave of advisory. They've already plowed through. The water is broken open. And if we can just hang on to the backside, we will see incremental growth that we've never seen before, because they've already gone through that turbulent time.
That's a great point, Terry. I wanted to actually, let's expand on that for a second. I'll go back to Terry, and then Clark, I'll kind of bring you in as well, because I know you guys both feel pretty strongly about this. We've had side conversations as far as where you all sit. And one of the things that is important, and I know you guys feel passionate about, is, we got to bring, if we're asking, for our advisors to create a better journey, we want our clients to go through a better journey, right? We've got to bring better tools to them. If we're asking them to do something and we're not bringing the best in class tools from a technology standpoint, makes it really difficult. So Terry, I'll start with you and then maybe go to Clark. In your seat where you sit, what are some of the tools that you've seen from a, sort of a better, faster, stronger technology standpoint that really help in the process?
Well, I think, again, e-delivery is huge. Anytime that we can embrace the technology to deliver, whether it's applications or policies or statements or communications through the delivery mechanisms of technology, is huge. But in I think like 2017, Mike, correct me if I'm wrong, we integrated our solution with Cover into financial planning software. And that was amazing, because we didn't have to stop the financial planning to go over and say, hey, Clark, I need an illustration now. And then Mike will get back together in a couple of weeks when I get my illustration back from Clark, and we'll sit down and we'll figure out where this fits in. They just get to click, and all the data is the systems are all integrated. So the data pulls in, and it's just, I want to say we probably do between 6,000 and 7,000 quotes a month off of Money Guide Pro. And my team doesn't have to touch that one bit. It's putting the tools back in the hands of the advisor and allowing them to be 100% in control. And they love that. Remember, they're type A drivers. If they're good, they want to control the client experience. And that's been a huge win for us. Huge win.
Yeah, I mean, just to be more specific, so the financial advisor does a plan. It takes them 3 to 7 hours to compile a full financial plan. But they now know the client's goals, they know their income and expense, and they know where they want to be in retirement. The Money Guide Pro platform now automatically calculates the insurance gap to make sure that the retirement plan can be completed in the event of a death of one of the two breadwinners. So it will tell the advisor, this client has a $2.1 million gap of insurance coverage. Great. The calculator that's now integrated shows the client how much it will cost them to close the gap for life insurance, long-term care, and disability income without the financial advisor having to do anything else. not one more keystroke, and they know approximately how much it'll cost the client to close that gap. And then they can actually get a real-time quote without, again, adding of any other keystrokes to show how much Prudential, Lincoln, John Hancock, Nationwide, Haven, Banner, AIG, Protective. So you can go all the way through the life insurance needs analysis to a cost estimate, to a real quote, to a drop ticket without leaving that environment, because the advisor is single sign-on. That's the power of that's what tech integration can do today. So again, as what Wade said, it's not incremental, that's fundamental disruption.
One of the challenge with the tools, and I can go over a couple of things that we're working on, but is is getting the funding to buy those tools. So as we got, I go back a lot to the investment advisory side versus us, and you have to really do a good job of explaining where you're going to get the funding for this. It reminds me of a story. Hopefully this isn't too long, but I was in a strategic growth meeting, and I was sitting next to the guy, a head of advisory, and he's like, man, we all got a 17% goal, or it really came out as 117% goal. So across the board, every product area, he goes, I can't believe I have 117% goal next year. I said, well, honestly, Will, I have 117% goal next year. You have a 17% goal next year, because 100% of your business is going to come back next year. You just have to create 17 more percent. I said, I have to recreate, or I have to recreate every dollar, since we're not officially scalable, until you use technology, as without technology, we're not. And so I think one of the things to get these tools, you got to explain the difference between advisory and us, how we have to start all over again and do it. But by starting all over again, we're meeting with clients, we're creating death benefits and long-term care benefits and all these other things that will stop those advisory funds from being liquidated down the road to pay for all that. So, I'm always like, you got to look longer term. For us, is we're the hedge so that people don't liquidate advisory. And of course, we have a little bit of different growth rates and stuff. But with that said, where we're really focused on tools is about data. Is where can we get the data inside our book of clients, especially as these organizations get bigger and bigger, is, we have all these insurance folks trying to look at every book review and trying to do all these things to find the clients, but let's drill down. And so what we're working on is data that can get in the Salesforce, come out of Money Guide Pro, go into Salesforce, just different ways that my team can narrow down what either the clients with an advisor that may have top things, like for example, a Money Guide Pro, if somebody puts in a large cash value policy, you can find that. But it might take me all day to find that, so we're trying to get some AI and some data analytics in there is, hey, Money Guide Pro, what were all the huge cash value, policies that were entered into the insurance module? Let's go find those. So we're really trying to digitize the opportunity report inside Money Guide Pro. So I'm leading a project, on that. And then there's other things that are sort of associated where we can do that, get it in the Salesforce, and be able to find it. Because I think the digital side, with the data is just as important as the delivery.
Sure.
I think, Clark, I think in the world that we live in today, of the best interest of client, data is going to be king. Mm-hmm. If we don't understand what we have, what we own, and what policies that we have, probably one of the greatest innovation tools that have come in my relationship with Mike and that cover has to do with exactly what you're talking about. And I recently was given the keys to the kingdom, and I was able to take a look at my orphaned business. This is scary stuff, folks, because best interest in client says you need to talk to these people on an annualized basis. And when you look at your orphaned contracts for the first time, and you see that you have over 120,000 orphaned contracts, and now you try to figure out how you're going to make those phone calls to those clients, which is about 400 calls for me a day, 7 days a week. I don't know how I can do it without tools like what we've been able to bring to market with our partners at Cover. Just absolutely amazing stuff.
And I think the corollary to that, where we were able to get the CEO buy-in on the wealth side to allow us to do this, because there's some data, conflicts and things that we have to do, is one of his concern is what if inside Money Guide Pro there is like something screaming like this person needs protection. Like we've delivered a plan that says you need a ton of life insurance, long-term care is going to really blow up your plan. And we don't do that, in the Reg BI world. Can somebody come back and say, look, you even did a financial plan saying, you were going to recommend this and you never activated it. So I think, these are some of the things that gives us the tailwinds, because like you said, it's hard going back to that first chart with 3% growth, saying that, as an industry, we should get all these new tools, but it just keeps hitting these other areas, I think, where we can get the leverage.
Steve, I don't know if this would address your idea of tools, but you can't sell somebody an insurance policy if you can't get them through the application process. And I think that what we've done with, I'll speak on behalf of Haven, what we've done with eApp. Now, Haven is a completely digital experience, right? So, and we started, frankly, as a direct-to-consumer company. So we had to build an application that a consumer could complete on their own. And then we also make that available now to advisors. And speaking of data, we're able to know very quickly if there's a part of the application that's causing problems, for people to get through, right? And so you can might be refiling involved, but you can make the changes to improve your application experience. So you got a greater likelihood that people are going to follow the process through. And I just think there's, as we've talked about historically, there've been so many reasons for people not to complete the process, and we're chipping away at those through eApp, through the accelerated underwriting and so on. So I don't know if that's what you thought of when you're thinking about tools.
Yeah. I'm actually glad you mentioned that way, because I was going to go back. Again, you and I are, when we spoke, big proponents of the customer journey, right? And you just mentioned that's a great point. There's no journey if they can't get through the application.
Right.
I wanted to ask you, that's really interesting. So from your seat, kind of, and I know you've been and have worked with carriers your whole career. So, a lot of carriers, they talk about evolving with technology, right? And everybody's talking about it. The reality is some are doing it, right? The things that you describe, a lot aren't. Like from your chair, what are you seeing? What are some of the evolutions in technology that you're seeing, in addition to what you mentioned with the the Simplified app?
I think that it's hard. Again, I'll speak from my own experience with Haven, right? Haven started as an independent company. And then when the CEO of Haven realized that the only way you can really transform the life insurance buying experience is if you're integrated with the underwriting process with a carrier, he sought a partner. And then ultimately, MassMutual decided to buy his business. And Haven is now a subsidiary of MassMutual. But we are completely autonomous. We don't reside in the company's home office. We're separate. So we're a separate entity owned by a long-standing mutual. And so we kind of built it all from the ground up. So I'm thinking about your term evolution. It's a little bit more of a revolution, I guess, than an evolution, right? It's hard to take legacy platforms, right, and move them into today's world. We didn't at Haven, we didn't hold ourselves back at all. We built everything from the ground up, and we decided that in order to deliver the experience we wanted, we had to build it all. And what I mean by that is it's the front end application. We built our own underwriting system that the underwriters use to underwrite the system, so the data can pass from the application easily to the underwriting platform. And we built the administrative system, right? People thought we were crazy when we said we're going to build our own admin system. But we did that as well. Initially, when we launched, we didn't have our own admin platform, and then so you controlled the customer journey up to a point, and then when they became a customer, somebody else was controlling the experience at that point, and we just weren't comfortable. So it feels to me like the right approach, and maybe I'm biased here, is to build it all and control it all. Otherwise, if you outsource any part of the business, you're outsourcing the experience as well. So I just don't know. We had a parent that was willing to let us operate in that environment. I I think there have been other instances where, you know, parent organizations tried to, you know, kind of have it work within the existing operations.
Sure.
And it's hard to do that way. I think it's got to be, we at Haven, we really view ourselves as a technology company that happens to do insurance. We're not as an insurance company, right? So I think it's that kind of mindset that's necessary to be able to drive this kind of.
Yeah, you know, that's so interesting. I'll let kind of the group comment on that as well. You just hit it right on the head, Wade, is that there has to be a different thinking there. You have to think like a technology company. You can't act and be like an insurance company, because you just won't evolve. You won't get to the point where, you know, firms will want to partner with you because you build a better mousetrap, you build a better process. I think that's a really interesting comment that you made. Clark or Terry or Mike, any additional comments on kind of what Wade had mentioned in regards to, you know, from a carrier perspective, that journey? What have you guys experienced there with different product providers? Any insights?
You know, one thing I think that's cool, and you know, I know Haven, you know, does a great job, and I'm not as familiar with the application process, you know, that I'm more on the front end, but I just love the whole smart, you know, application kind of a concept. You know, when folks say, hey, we're digital, but it's really just a PDF, you know, that you now have to do online, you know, that's not digital. In fact, that's sometimes harder to do, you know, but what, you know, the companies I go toward is smart, you know, kind of application that if you check yes, you know, then you skip to number 3, you know, it does all those kind of things for you. I'm sure Mike's smiling because I'm sure that's all he, you know, he wants and does business with, but you know, that's always been my thing with some carriers. They stretch the term digital when it's really just a PDF, you know, attachment.
We now use the term, Clark, digital and digitally enabled to segregate the old from the new. The digital is Wade and a few others. Digitally enabled is everybody else. So we put a little front end on it. So it is digital, it's reflexive, it's as common as we can, but there's still a little layer of translating, you know, paper oriented things. So, you know, for cover, 32% of our sales last year were in fact digital, and 68% of our sales were digitally enabled, which included some form of people, fillable form, phone call, paper delivery, where we couldn't do a DocuSign application. We couldn't do a DocuSign e-delivery, but we were 32% across all of our accounts, 32% all digital, which was a great outcome from where we were five years ago.
Well, Steve and Tim, we've got one comment coming in over the chat function. It's from Billy from Bailey Savings and Loan. He says, here in Bedford Falls, we find that clients usually take the advice of their advisor and buy the investments that the advisor recommends. All this talk about client experience and client engagement, we think it's really the problem is advisor engagement. How the heck do we get advisors to want to address the risk management needs of their clients? They don't seem to want to. Tim, that might be a good segue to the data we have on financial planning.
I will pull that up.
We've, it's generally believed, and a few of you kind of alluded to that so far, that when advisors do financial planning, they're just going to sell more life insurance and disability products and long-term care insurance, because it's kind of hard not to. If you're being a holistic advisor, you're going through the plan, and up are going to come the insurance solutions. The data don't support that. And we have data from MoneyGuide Pro users in banks, from 2,400 MoneyGuide Pro users in banks, 54,000 plans, and it allows us to isolate the impact of doing planning on selling life insurance. And we do that in a kind of sophisticated way because we're able to predict what we're able to control for all the factors that influence insurance sales and isolate the impact of doing plans. In this database, the typical advisor works on 24 plans a year, either new plans or updated plans. And controlling for the other factors that could influence how much insurance and advisor sells, like, for example, how much advisory business they do, how many assets they have, what's the size of their deposit territory, how many clients do they have, how old they are, what's their tenure, all those factors that can influence what how much an advisor sells per se and how much life insurance they sell. An advisor who does 12 plans a year sells about $5,000 in life insurance a year. An advisor who does twice as many plans a year sells only $4,500. And an advisor who does 36 plans a year sells $4,100 a year in life insurance revenue. That's opposite of what we would expect. But that's because planning doesn't drive life insurance sales per se. It's what's in the plan. For example, in these plans, the typical advisor does only 7.5 plans a year that address healthcare needs. That's 34% of those plans. But if they could double that number of plans with healthcare needs from 7.5 to 15, then they would increase their production by 15%, by 37% if they're part of a team. Because one thing that comes through in this analysis is that planning doesn't drive life insurance sales, but being part of an advisor team does. Advisors and teams sell much more life insurance, long-term care insurance than advisors not in teams. Well, what's the key then? Well, the key might be, does the life insurance plan include, does the financial plan include life insurance? Because almost none of them do. Of these 54,000 plans, only 1.1% of the plans included life insurance, even opened a life insurance module. But the advisors who did do that averaged, almost $1,100,000 a year in life insurance revenue, twice the insurance revenue of the typical advisor in the database. And again, controlling for all the other factors that could influence life insurance sales. If they were to double the percentage of plans, double the number of plans that include life insurance from 1% to 2%, a very small step, life insurance sales will go up by 12%. And imagine if they did 5% or 10% of plans with life insurance, which they probably should be doing. Steve?
Yeah, thanks, Ken and Billy. Thank you for that question. I think we'll get to that. But then let's kind of address what Ken had mentioned here and some thoughts I had as I'm looking at this data, and I wanted to open this up to the group. So Ken made two great points there. Number one, it's not the plan, it's what's in the plan, right? So let's talk about ways to implement insurance, like kind of that blinking red light. Okay, this is insurance. You need to talk about insurance. The second point was that screaming number that Ken mentioned, that 1.1% of financial plans, including insurance. Every time I see that, I'm just blown away rather by how low that number is. I guess I shouldn't be shocked, but it's so low. So those 2 points that Ken brought up, I guess I'll open it up to the group and would love to get your guys' thoughts on, okay, so financial planning, right? If we're talking about planning and we're talking about insurance, it's going to have a dramatic impact. How do we get them talking about insurance, and how do we use technology at our fingertips and what we've talked about today? How do we use to kind of that technology rather to drive that?
Yeah, I wonder about the data. Data's good, but advisory truth is another segment, because a financial plan without life insurance is nothing more than a glorified retirement account and an analytical tool to tell me whether or not I'm going to have the propensity of making my goals become a reality. And an advisor that isn't utilizing a financial planning tool for all 8 modules or 9 modules, if you're using the long-term care module to be part of that conversation, it shouldn't be called a financial plan, because a plan deals with all of the pitfalls of life. And the 54,000 plans, if 1% of them were generating life insurance sales, we have 53,000 opportunities to revisit that financial plan and change the behavior of those advisors. And I truly think it's just a community, the larger, broader community that I will say that some of the greatest conversations we've had recently have not been driven by industry leaders, carriers, companies. They've been driven by peer-to-peer learning. And all we have to do is to start to think about all the regulatory stuff that we're being faced with today, all of the disclosures and all of the types of things that we're going to have to be doing. And, Clark, you're spot on. Why I would be scared too if I were offering up financial planning and using any financial planning software and calling it a financial plan if I'm not bringing into that conversation protection. Because you're right, it's going to happen where somebody is going to challenge an institution, a broker dealer, a carrier, somebody. They're going to get challenged because they didn't offer it. And that's really probably more about additional data, right? Where are the notes? What are you doing for your financial institution to protect that institution by asking those questions?
Well, in this case, Terry, in fact, the data is available to the institution or the sales manager. They can look at the reports from Money Guide Pro, and they can see that 99% of these plans did not include life insurance for that advisor, right? So where does the buck stop?
Right? Ken, it's exactly where I said before early on is that if it is important to offer, it's got to be important all the way up the line. Everybody has got to be part of the team. If you're into, watching rowing this year in the Olympics, you're going to see that, there are very few boats that get out there and there's only one person in there that are going to be successful. You need to have a whole team of people. And that starts at the top with your executive team to say, it's important that we offer this, guys. We do not want to be that flag that's waving out there that says, hey, we let you down. I mean, we're the institution that lets people down. No, we want to be the institution where people stand in the door and they want to come in and they want to work with you. And I'm 100% with you, Ken, that we have to have tighter controls from management to get into the belief. Provide the reports, coach, teach, and train your program managers on how to obtain those reports, and then partner with the right people.
On the side of the equation as to why are they not talking about insurance? It's because they're uncomfortable with it, right? It's not what they do, right? And so probably no surprise that Haven, one of our major clients, is MassMutual, right? So MassMutual's career distribution system has utilized our technology, and some of the MassMutual agencies are very heavily oriented towards investments and don't actually do a lot of insurance, specifically some of the ones that came over from MetLife during that acquisition. And so we've had instances of people who the leadership of the office said, this individual will never do insurance. Give them a demonstration of the platform, and they talk about insurance with every client now because they actually don't have to do it. They can send the client a link and let the client do the work, right? Rather than having to ask them questions about their health history and so on. So to your point, Steve, about how does the technology impact this, right? If the technology enables customer self-direction so that the advisor doesn't feel like they've got to get themselves embedded in a process that they're just not comfortable with, it opens up the door. Right?
Yeah. I was thinking I wanted to address the question from earlier. I know Ken had 2 points talking about the financial planning, but then also the question that came through as far as engagement. Guys, I was thinking about this the other day. I was kind of preparing, right? We talked about Mike, and I know Wade, we talked about how we feel about that customer journey, and we've touched on it a lot this afternoon. I was kind of thinking also as far as engagement, right? We as sort of leaders of financial institution programs, right? We also have to look at our advisors as sort of the customer, right? In this really ultra competitive landscape for attracting advisors, what kind of experience are we creating for them for their journey, right? Because as you guys know, right, if they have a bad experience, just like a client, they're probably not going to do it again, and therefore they're not going to be engaged, and that's a big challenge for us. Wade, I guess I'll start with you. Maybe this is a good one for you as well, Mike. Is the aha moment just that better advisor experience where they go through it a couple times, it worked great, it was cool, it was smooth, and now they're engaged?
Yeah, and I think. Go ahead, Mike. Jump in.
Wait. No, go.
No. Yeah, no, I think that that's exactly it. They've got to either they've got to experience it, or I think Terry, it might have been you, was talking about peer-to-peer testimonials, right? We do a lot of that as well, to get people to understand that the process doesn't have to be what it was in the past, right? That we've simplified the application process. We've enabled a situation where the customer can be a lot more involved in that. We through the accelerated underwriting, you've got opportunities for a much shorter underwriting process. Even when you don't get accelerated underwriting through some of the technology enhancements, you can issue fully underwritten cases much faster than a few years ago. So all those things are learnings that you need to get out there in the advisor community, so they understand. It's not your father's Oldsmobile, right? That times are different. Go ahead, Mike.
Just going to add, give three, tangible examples of where we've started to create raving fans. And Cover doesn't have everything solved by far, but the disruptive things that we've done are pretty tangible. So just three quick things. So first of all, we do net promoter scores, and I know everybody knows what net promoter score is. We all get surveyed by our airlines and our restaurants, and we push out our net promoter score, and we send it out to advisors and we send it out to clients. So we do look at the advisor as a customer. So Cover's net promoter score for the second quarter was a 52. It's off the charts good for insurance companies. 52 is like right up there with your iPad. It blew us away. Our net promoter score 4 quarters ago was 18. So, that shows maybe how we've gotten better, but it was a 52. I shared Terry's results with him, and there were, I think, 37 financial advisors at Cetera that gave Cover a score. So that's our scorecard. If we can't get above a 50 net promoter score, we haven't satisfied our customers. Why did we get a 52? So the first thing that's different is when that financial advisor determines if the client needs insurance, they drop a ticket and then everything else is done. They start the journey with the client that says their client's going to get a phone call from Cover, and the client can pick a time on like a calendar, like Calendly. The advisor gets a confirmation, and then the client gets a phone call, or they get an electronic application to fill out at the time that's convenient for them. So we've taken everything out of the advisor's hands from that point forward, and we keep the advisor 100% in the loop throughout the journey. The second thing is 100% of policies are electronically delivered now. If anybody remembers or still uses paper policy delivery, so an insurance company mails a policy to Cover in Boise, Idaho. Cover mails it to the branch office of Cetera or Morgan Stanley or US Bank. That person has to call up the client and get the client to sign a delivery receipt. And then we have to get that signed delivery receipt back to the insurance company. 21 days to deliver a policy and 4 postage stamps or a fax. We're now 100% DocuSign for policy delivery, which takes 1 day. The policy is in a PDF form. You put it in a DocuSign, you send it to the advisor and the client. They sign the DocuSign and the transaction is done. The policy is delivered. It is fundamentally different than anything else that we've done. Sounds like a small thing, but massively high satisfaction levels on the part of the advisor. And with Cover, this is a shameless commercial for Cover, so I apologize about that. Cover has one policy delivery process for every insurance carrier. So whether it's Pac Life, Prudential, Nationwide, John Hancock, Protective, because they all have their own e-delivery portals, which require individual sign-ons. Every one of the policies that we deliver is the same journey through the same DocuSign. It's not different from Prudential to Pac Life to, Equitable. So that's just made it a lot easier. So that, again, digital innovation, common experience, improve the user journey. Like, it's real now. It's real. And those advisors that have taken 30 minutes to try and learn it have become raving fans. Those advisors that thinks it's your father's Oldsmobile, they're still not doing the insurance and financial planning.
Right, and so that seems to be the issue then. It's a lot easier for all the reasons you said to go through the advisor journey than it used to be. But how do you get them to take those steps? I mean, Peter, you've seen lots of examples of people try to use financial incentives or other ways to encourage them to take that step. Could you kind of
yes.
do that for us?
Thanks, Ken. Good discussion, everyone. Tim, if you could maybe put up the couple slides on compensation. So the first thing, we have to address compensation with advisors. I mean, one thing that we've learned is that, advisors care about how they're paid, and firms pay to what they want to have happen. So what we did here to start with is to look at what firms are doing currently to pay advisors additional for insurance business. And this is from the forthcoming 2021 advisor comp study that we'll be producing here later this year. Thanks to those of you that have provided your advisor compensation plans to us. For those that haven't, there's a few on the call today. We could get to 50 with your participation and make this data even better. So I'd encourage you to provide those to us. What we found, though, is the 44 firms that we have data on so far, just 7 of them included some type of enhanced compensation. And by enhanced compensation, what we mean is the advisor is paid more for doing insurance. And some examples are, an additional 5% to the grid for insurance business to what else they'd be, to whatever else their base grid rate is. Or 40%, on a flat grid when advisors, might be earning 30, 32, 34%, so it ups the grid on insurance business. Or giving, the advisors a 45% credit if they've trained their licensed bankers to do single premium, just, to get insurance business going. But the key is that 7 of 44 firms have even made it only 7 of 44 have even made it part of compensation. And these amounts, are not enormous. I mean, they're just, 5% more to the grid when you're only doing $5,000 in insurance business is not going to change, the date of retirement for an advisor. It just isn't enough. So let's go to the next one, Tim. So now a couple firms, 3 of them of the 44 have taken a different approach, and they're trying to make insurance more of a requirement. And what these firms have done is 3 examples here. One of them holds back 10% of the advisor's commission on all their business. And then they can earn from 0 to 150% of that holdback once they achieve training, financial plans, life insurance as the 3 measurements. So, a little different approach in that, they're having that advisor earn their commission twice by providing these things that strategically they believe are important. Okay, so a little different. Annual incentive rewards payable in restricted stock units are eligible only if the advisors meet financial plans, new managed money, and insurance. And restricted stock can be a nice financial reward for advisors above and beyond the grid. And then a quarterly, the third one is a quarterly firm-wide incentive pool, weighted evenly between financial plan and insurance revenue. And that is then paid out to advisors that achieve the most in planning and insurance. So some different approaches, but I think the challenge here is that few firms have really made this core to what they pay advisors on. So still, and of the advisor total compensation, 95% or somewhere in that range is 100% just flat out bottom line production. So where compensation could be a lever, it's only being used sparsely, and the amounts that are used are somewhat modest in many cases. Okay, so there's opportunity there. And I think the compensation and other parts of this business require a bigger picture solution to it. It isn't just, do you up it from 40% to 45 or 50 and think that that's the solution? I think there's a bigger challenge that we need to solve within our businesses. And Tim, if you would advance one more for me. So this to me, having consulted with these firms, seeing what firms have done, running programs, being in our world, for approaching 40 years, this is, to me, sums up our overall challenge with how banks have run, financial institutions have run their investment program. And what we've done as a bank is that we started an investment business. And in the early growth stage, it made a little bit of profit. And we cashed in on that profit. We stopped investing. We stopped growing market share. We stopped trying to take business from others, and we just wanted to grow the profitability. And we have missed the opportunity to really make it a significant part of our banks. We have 5% of the advisors in the industry. We do about 5% of the business in the industry. What we did is we settled as banks for small and early profits. If there's one mistake that I can tell you that I think banks as an industry have made with their retail investment institutions, it's this. Okay, so here we sit today with insurance. What are we going to do with insurance? The leaders of not the bank, the investment program. What are we going to do with insurance? Are we going to run it the way banks have for 40 years and take this early and small profit? Because that's what we've tried to do. We're worried about every advisor that sells insurance and every policy that we write having a positive margin, contributing to bottom line. That's why we're paying 40% or 5% more, because we have to make a profit on each transaction, because that's how we think. Well, what we've done is that we're doing exactly what banks have done to the retail investment business, is we cut out far too early. We cut out before the bank owns 25% of the investment business in the marketplace. We cut out before our advisors get 25% of the insurance business from our clients. Let's not make that mistake. I would encourage us, and I would ask each of the firms that are on here to really think about ensuring that they make absolutely no profit on their insurance business. It sounds crazy to say that for a bank. Look what that approach has done for retail investments. It's capped at, having that profit is capped at 5% for 40 years. Let's not make that mistake with insurance. We can start insurance today, making it a growth engine within the bank, as long as we run it at a stage that it is. And the stage that it's in is to gain market share, to build advisors' skill in selling insurance, to put the platforms in place so that you truly can offer digital offerings, so that you have a broad selection, so that you have the back office, so that you can pay appropriately on the business, so that you have the right training. We should be building that out as a financial institution and say, what a tremendous opportunity to be able to have a product like this, a service like this, that fits in so nicely to our core business. And all we have to do is put effort towards it, not worry about making money day one. And it'll lead to a much brighter future for our overall business and for overall clients. That is, I implore you all to really take that approach from a big picture consultant. If I look at this industry and our business, I think it's an opportunity, but only if we manage it as the opportunity that it is, and not manage it in a way that shortchanges it, that settles for these small and early profits before we can grow it and get the large and lasting profits that business can really bring us. So, that's the overall picture on insurance. It's certainly, the technology component certainly helps us do this in a way, that alleviates some advisor challenges and fits in to making it core. And I think it's just a very integral part of that approach. So, Tim, back to you on it.
Thank you, Peter. While you were chatting, or while you were talking, rather, we had a chat come in from one of the audience members that I think reinforced one of your points. So his program falls into one of those covered by your first slide, right? So he pays as much as 50% on the grid for life insurance sales, and he says it hasn't moved the needle at all.
Yeah. Well, they're still probably trying to make a profit on that 50%. And we have zero market share. So why not try and build market share instead of worrying about profit on money that, quite honestly, is negligible to the bottom line of the bank? So I'm not surprised in that.
But it also is indicative that there's something else here. Because usually if you pay an advisor a couple of pennies more, they'll move in that direction to get those pennies, right? But they're
Many times.
Yeah, but they still aren't doing it, right? And it might be the things some of you have talked about,
Right.
that have the old experiences they're remembering, and they're remembering that, that car was hard to steer. And I don't.
So scorekeeping counts. Clark said it very early in the meeting. A lot of wealth management firms are driven by assets under management, scorekeeping, assets under management, AUM, assets under advisement, assets under management. Insurance has to get in that scorecard. If it's not in that scorecard, it's not top of mind. As human beings are competitive, you move up grids, you move up the rankings. It surprises me more wealth management firms don't find a way to equalize crediting. And I know one is brokerage and commissions and the other is recurring revenue. I get all that, but I think that would be a great step, is to just score keep on a level playing field to send the message that it all matters, assets and protection.
Yeah.
So I think that would be a big help in this area, however that gets done.
Yeah.
And I think that sounds right, except we've seen examples of firms that stack rank their advisors on their insurance sales. And if you're in the bottom quartile, you don't seem to care if it's insurance. You do if it's advisory, or you do if it's
Right.
Well, but there shouldn't be two rankings. There should be one ranking. If you're ranking the silos and you're queen of the pigs in the small race, nobody cares. But if you're king of the hill in the big race, then everybody cares. So
you're recommending then that it's only insurance in the ranking?
No, it's equating. So if you get credit for your insurance under advisement in the same system that ranks your AUM, and it's dollar for dollar equated, then everything counts the same way. You're just helping clients, whether you're helping clients with AUM or you're helping clients with protection. If it's in one scoring system rather than separated sets of ranking, that I think would make a difference, because it all matters. It's all planning in the way that I look at it.
And you might be right, but we've seen that cat skin many different ways, and in the end, not enough advisors take to it, right? Whatever the carrot is, whatever the stick is, and there's something to be said that maybe there's a stigma here. To the product, maybe.
I think a lot of it is what the advisor views as their role. We see the same problem with financial planning, in that advisors, are still at two on average financial plans per month, because many of them don't view planning as part of their role. And I think the majority of advisors don't view insurance as part of their role. And that has to be fixed at the top of the house within the firm for every advisor that you have, that you hire, that you train. And until that becomes part of their role, until the firm takes the really important and difficult steps to make it part of the role, we end up just changing things on the margin.
Just one more example. I know I'm overstepping my boundaries here, but when you look at your own personal net worth statement, if you own life insurance, do you know what the biggest asset is on most people's personal net worth statement?
Social Security.
It's life insurance.
Social Security is bigger, I think, but
if in my household, where I have a $5 million policy, the biggest thing on my net worth statement is my life insurance. Okay. It's the biggest number. I have seen some firms, when they look at total wealth of a client and they score keep, they put the death benefit, because that advisory firm can retain those assets if that client dies. So for the $10,000 it costs to put a $5 million insurance program in place, that wealth advisory firm has the chance to retain $5 million of wealth for a $10,000 annual spend. Like, that's a way to look at net worth a little differently than the way we traditionally score keep.
Great point. I think that's spot on for sure. Yeah.
And Peter, I agree with you about the we're worried about 2% revenue, and 98% of your revenue is coming from the other financial tools that you have. And if you want more than 2%, you got to figure out a way that you can grow that organically. It can't be the transactional growth that we're seeing today from an advisor standpoint, because a lot of advisors, even though we call them advisors, they're order takers. It's a transaction. They get self-gratification, they move on. Advisory, they turn the lights on in the beginning of the month. They know what they're going to get at the end of the month. And if they make transactions along the way, great. If they don't, they already know what they're going to get paid. So that we have to, and I love the idea of, and I'm going to steal some of this stuff about, educate yourself, join a study group, become a better financial professional is what I would like to call them. Because you're giving advice, you better give all the advice, or you shouldn't be called a financial advisor, because we give advice. And going back to what Clark said early on, if we're giving advice and we're not giving all the advice, we're giving liabilities to our financial institutions that someday may be cashed in on.
One thing, just to use an example, is our top FA manager. So we struggle on the brokerage side inside Truist. The wealth advisors, who are more probably looked at as employees of the bank, they have goals. Their managers have goals. They have activity goals. So we do 70% of our revenue with those. But the one FA manager who's consistently top, it's all through coaching, and what he coaches on is planning and with advisors on what is what's doing best for their client. And it's really funny. I mean, like when he sits down and they say, hey, you know, I am a holistic financial planning thing. And he's like, well, then why don't you do insurance? They, you know, give all the excuses. He goes, but I thought you said that you have the client's best interest in mind. And that's what he does all the time in his one-on-ones. He's our number one, you know, FA manager that, you know, it's finally, I think, you know, Terry, you were just saying it about improving the professionalism. And that's, you know, what it really is. Because if you bring it down to numbers and a lot of other things, I say again, you're better paid in the long run if you go put all your time into advisory. And it's easier, you know, it just keeps growing, you know, it comes back to you all the time. You know, insurance takes work, but if you truly are professional to help people and you have leaders that have goals, you know, that want to help you do that, it comes out. That's the only way we figured it out with FAs is you got to call their bluff and their pride that, you know, are you really doing what's best for your client? You always say that, but how can you be if, you know, if you're not looking out after their protection planning?
You know, in closing for me, I would just like to add that, you know, adding a digital component to my offerings, and we offer insurance services the old school way of point of sale, and we have a digital experience which Mike's team heads up for me. It's really been interesting, the journey that I've been on with Mike over the last 6 years, and how hard the hustle has become, you know, because our clients are becoming better educated. The information that's out there, the ease to buy product online without an advisor, all of that type of stuff. But what I've really become focused in on, Peter and Ken, is that if we are going to get better as an insurance community, we need to deliver faster. The experience can't be that we're going to deliver in 90 days. In my cycle times, January 1st, were 89 days. And I threw a challenge out to Mike and his team about a month ago, probably less than that. And my cycle times are now down to 43 days. And I said, I want you at 42 days to be really in line with what we're doing. And it can't happen by doing paper. It has to happen only with the experiences that you have with digital. And there are many offerings that are out there, other firms that offer digital experiences. If you're not offering a digital experience, I highly recommend that you line up with somebody and start asking some questions about how they can help you align and deliver a better experience to your advisor community, but really to your clients and members that are out there, because they're the ones that are really the ones that are suffering when we have time to market. So
Tim, we've got one more comment coming in. There might be a good way of summing up this conversation. It's from our old friend Richard Federer from Fort Lee Savings in New Jersey. He says, here in New Jersey, we feel like selling insurance is like having a baby. It takes a long time, and it's frequently messy and painful, and it's really hard to speed it up and do it right. Steve,
I would just say it's the art and the science of selling insurance. To Terry's point, there's still a role for long, messy, personal discussions, integrated planning, meet the family, establish the need. You know, the people relationship part of this business is still very much alive. There's a combination of digital, quick, do it the way you want, schedule online, get it done immediately. That has to be a component, but that part of our business hasn't gone away, and nobody here, I know Clark and Terry and Wade, we all believe that part of it's still here for a long time, and tech is going to enable that, but not replace it. Mm-hmm. So, you know, kudos to the comment.
Mike, I thought you were going to say you're the epidural.
On that note, you guys, I know we're right at our time. I guess this has been a great discussion. Probably could have a client journey part 2. This has been really terrific. Maybe we'll think about that. Terry, Clark, Mike, and Wade, thank you so much. We really appreciate it. And I'll hand it back over to Tim for any closing remarks.
Yeah, just thanks once again to our sponsors, Cover and Haven Life. As Steve just did, thanks to our panel today, and thanks also to our audience for giving us a few extra moments of your time today. For now, we don't have another virtual dialogue on the schedule, but I wouldn't count us out of that game quite yet. So look for news on that front. We are looking forward to returning to our usual lineup of in-person study groups this fall. I've got some topics and some dates on the screen there, and there's more information about those on our website. So thanks again to all of you, and I hope to see you again soon.
Thanks, everyone.
Thank you.
Take care.